Welcome to another episode of Heartland Market Talk on the open range. Well, the oil market has been listless, as we discussed the last time here in the episodes, that the price range seems to be defined in the $77 to $80 range as oil pinballs inside that pricing. The typical seasonal rally that goes from the wintertime into the summer seems to have peaked back in April during the intensity of the Hamas and Israel fighting. And since then, the market has drifted some $10 a barrel as you're seeing the prices soften at the pump. Some areas more quickly than others. But as the oil prices stabilize here, you're going to eventually see the demand from the Memorial Day weekend probably not see the price bumps that we normally see because they're getting the product together at lower prices. Now, the gold market, as of late, rallied back to the highs made a month ago, challenging them, actually going through briefly, making a new record high, but then cooling off as traders take profits here into this recent price rise. The gold market did stumble, but it's still holding some uptrending support at the 104 value, which implies we're still kind of at a mix with what the Federal Reserve really is going to be doing later this year. The trade seems to be convinced with recent data that the Federal Reserve may lower rates in September and again around election time, which typically the Federal Reserve always works for the political power that is in power, and with that consideration, probably going to get it. Now, the Russian wheat crop continues to make headlines. Over a week ago, it was about the freezing. Now it's about the ongoing drought and warm temperatures that could typically have been in place here since spring. What's ironic about the freeze is typically during a cold weather event, it stays cool for a while and typically there's rain around it. This allows the wheat market to stool, but that's not the case this time. The market quickly went back to the drought conditions for the Black Sea and Russian wheat areas. Ukraine and Russia is included in this, that wheat valuations have been rising in price while the marketplace continues to lower down expectations by 10%, if not more, on Russian wheat losses. Now it's time for Heartland Insights. Now, as we discuss Russian wheat prospects, here is the Black Sea region. Over here is Ukraine, eastern Ukraine. Last week we showed you the poor vegetation growth, along with this area as well, poor vegetation growth in Russia that is not getting rain, and there's no rain in the forecast out through June 1st. As that crop continues to look to struggle as wheat values will contrarily, rather than moving lower this time of year ahead of the U.S. wheat harvest, could firm. And in 2010, we had seen wheat prices firm all the way through the month of July. Not saying it's going to occur this year, but the prospect is there on that Russian wheat drought. Now, the U.S. continuing to see large, copious amounts of rain here. Illinois, Indiana, Ohio, behind on planting progress. Even Minnesota needs to get a break. And so the last 30% of the corn crop, which should be in literally this coming week, is not going to occur. And so now we are pushing the pollination period for corn later into July, and along with the soybean podding and flowering or during the heat of August is going to be a problem with production. So trendline yields are at risk because of this weather. Now, the corn market, remember back in February and March, we talked about this V bottom creating a potential lift into the second quarter. That is occurring, and last week's high did bring about a 4-day solid correction, but we're seeing the market respond back higher again as this weather issues for corn could produce 1 million acres of loss in our upcoming June 30th acreage data, where many were anticipating back in March when the USDA said 90 million acres of corn could be planted. Pretty much the grain analysts were saying, nope, it's going to be higher. Well, now it's almost certain lower, either through preventive plant or switching of corn production to soybean production. Now, soybeans as well, maintaining an upward bias since our February-March lows, maintain that second quarter rally that typically occurs into May and potentially into June yet. Now, the wheat market, Kansas wheat made a high last week, broke hard 4 days, but it's this Russian drought that does not want to break, bringing us back up to the levels of last week, which pretty much matches us above last fall's highs. And now Minneapolis wheat, same thing. We're back to last fall's highs, but prices should be breaking higher because look at September French milling wheat. This is the European prices that compete with Russian wheat. We've already recovered to levels not seen since last summer's highs. So if that was the case, our local domestic wheat values still have another 50 cents or more to recover to as we continue to see that trouble with Russian wheat production, which has been the albatross on the wheat market's values for the last 2 years. Now, crude oil, again, struggling to maintain trendline support as we discussed how this $80 value is significant resistance. Even when you look at it as downtrend line resistance, we see an oil market that has peaked back in April rather than in the late May, early June time window, that the price of oil is running the risk of breaking down and moving lower into June, if not July, which is what occurred 2 years ago. Now, in the spot gold market, here is that challenge of recent highs from early in April. Market did stall again. We'll see with more Fed minutes and announcements coming up whether the gold market will double top here and retreat for a while or keep moving higher. Seasonally, gold makes highs by April and May and softens into the summer months. Silver, though, finally coming alive. It's been the weak sister in this market, blowing through its early April highs when it matched with gold and went well above those values by almost 10%. Now, if you look at a monthly chart, you can see silver is way behind gold as gold is exceeding its 2011 highs already by 15%, whereas silver has barely recovered about 50% of that amount. Taking a look at the spot June cattle market, we're seeing a recovery in the beef market again after trending lower on the avian flu issues that kind of overcame the market in early April. Box beef values have recovered with not only choice well over $300, we're seeing select even climb above those levels, but that's not a surprise given this time of year ahead of Memorial Day weekend. We see an improvement in box beef, but if we do not see good offtake, box beef prices can tumble after the start of the month, and here June cattle is up against resistance, looking for 183 to 184 to be a problem price for this contract. It's time now for the question of the day, and we've had a viewer ask, what is the difference between tick size and tick value? Aren't they the same? No, they have a specific purpose. Tick size is between the various contracts, like crude oil. Tick size can be 1 penny. So 1 penny on crude oil on a 1,000-barrel contract is $10. Move 10 cents, it's $100. Now, tick size in grain is a quarter cent, while tick value is on 5,000 bushels gives a quarter cent tick value $12.50, because a full penny from a quarter cent becomes $50. So you see a distinct difference between tick size, that is what the commodity, and what the value of that tick size is. Don't forget, if you have any questions, you can email us at info@heartlandinvest.com, and we're glad to answer your questions on any stock market or commodity market questions. Remember, you can always call us at 701-222-0221 or visit us online at heartlandinvest.com. While you're there, don't forget to check out our Heartland Market Talk podcast and sign up for our daily newsletter. And for producers, remember, we offer crop and LRP insurance as well. Thank you for watching this episode of Heartland Market Talk on the Open Range.